Do you think you can successfully start or run a business without a plan? No, it's impossible. Whatever the business, whether small or big, you cannot succeed without a plan, a clear and detailed plan that covers every aspect of your business. There is a saying in business, if you fail to plan, you plan to fail. And trading is not an exception. Trading is also a business. And to become successful in this business, you need a trading plan, a detailed plan that covers every aspect of your trading career to help you succeed in this business, to help you stay in line and follow the rules for reaching to your expected result. In this video, I'm going to talk about the important elements of a trading plan and how you can create and develop your trading plan. This is a very important subject in trading, so please make sure you watch this video until the end because you need to consider all the points and tips explained in this video. Otherwise, you cannot develop your trading plan properly. I recommend you to take your paper and pen and start writing down the points that I'm going to explain, because at the end, you're going to have your trading plan on a paper, a clear and detailed plan which is created and written down on a paper. Without wasting any more time, let's get started. First, let's see what is exactly the definition of a trading plan. A trading plan is a comprehensive and systematic decision-making approach for your trading activity. It defines what is supposed to be done, why, when, and how. It covers every aspects of trading from before taking a trading decision up to after the trading decision. The first step is to define who you are, what kinds of a trader you are. You must come up with this decision, what trading style suits you: scalping, day trading, swing trading, or position trading. If you're already a trader, so you know what kinds of a trader you are. But if you're still trying to find out what kinds of a trader you are, this is an important decision for you because each trading style has its own advantages and disadvantages, and they may require different levels of experience. Scalpers usually hold their positions from a few minutes up to even few hours if they are waiting for their target to be hit. It's a very fast trading style, and during the day many positions are opened. Scalpers try to catch very short movements of the price and they collect small profits. This trading style needs experience and strong emotion control skills and not recommended for beginners. Day traders hold their positions from less than an hour up to 1 day, but not more than a day. They don't hold any position overnight. Day trading also needs experience and good level of trading skills, and usually not recommended for beginners to start their trading career with day trading style. Swing traders hold their positions maybe from less than a day up to few weeks depending on when the price hits their targets. They hold positions overnight and usually the holding period is several days, and position traders hold their position from a few weeks to many months. They are actually considered long-term traders. Please pay attention that there is no exact borders on these holding periods, and this is just an approximate and average of holding positions in different trading styles, and depending on when the price hit the target they may fall in different categories, but this is how they usually are on average, and it's a good guide for you to decide what kinds of a trader you are or what kinds of a trader you can be depending on your personality and life condition. This is the most important decision that you must take because everything that comes after this are directly related to what kinds of a trader you are. In the next step, based on your trading style, you must choose your chart time frames for trading. Scalpers usually choose time frames from 1 minute to 15 minutes using the upper range, for example 15 minutes only for major trend or support and resistance, not for trade entry. Day traders usually use 5 minutes up to 4 hours. Here also they use 5 min for precise entry and exit points, and on the other side of the range 4 hours only for major levels of the market, and usually not entry because, for example, entry on 4 hours maybe force them to hold their positions overnight before reaching to their targets. Swing traders choose time frames from 1 hour to daily, and position traders usually use daily, weekly, and monthly. Here also please pay attention that there is no exact borders on the choice of time frames, and in practice it also depends on the trading strategy. For example, in a day trading strategy you may use 15 minutes and 1 day time frame. This is just a general framework based on what time frames traders usually choose based on their trading style, so you can have an idea in your mind that, for example, if you are a day trader or a swing trader, what range of time frames better suits your trading style. So in this step you must exactly define on what time frame or time frames you are going to trade. In the next step you must decide on what markets you want to trade. Is it forex, crypto, stocks, commodities, indices? You must exactly define in your trading plan on what market or or markets you're going to trade, and also in each market on what assets you want to trade. For example, in Forex, only major pairs; in crypto market, only Bitcoin to USDT; in stocks, only Apple, Tesla, and Microsoft, and like this. So after choosing the market or markets that you want to trade, you must also have a list of assets in those markets that you should focus on. It should never be like a random exploring of different charts just to find a trading opportunity. In your trading plan, you must exactly define what markets or assets you're going to trade on. In the next step, you must define what kinds of analysis you are going to use. In general terms, is it going to be technical analysis, fundamental analysis, or both of them together? If it's technical analysis, are you going to use price action analysis, technical indicators, or both of them together? In your trading plan, you must exactly define how you're going to analyze the market and to what extent you're going to use each method. Please pay attention that choosing type of analysis also depends on your trading style. For example, scalpers are more focused on indicators since they enter or exit quickly and they just look for buy-sell signals. Day traders have more time for analysis, so they also apply price action analysis alongside with indicators, and also news and fundamental analysis can be considered. For swing traders, the weight of fundamental analysis become a little bigger in compared to day trading, but technical analysis still plays the major role most of the time for finding trends and swings in the market and better entry and exit prices. And for position traders or long-term traders, fundamental analysis becomes important part of their analysis since they are deciding on the value of the asset and holding it for a longer time. But here, still technical analysis can play a role for identifying trends and major levels of the market and finding the best entry and exit points. Please pay attention that these are not also exact rules and they are just based on what traders generally do on average. We have day traders who trade only based on news, and we have position traders who are mostly focused on technical analysis. In the end, it depends on the trader that what types of analysis works for him to make consistent profit, and this is achieved only by experience and practicing. In the next step, you must decide on the type of your strategy and under what market conditions you're going to trade. Is it trend following strategy or it's counter trend strategy? Is it reversal strategy, volatility strategy, pullback strategy, or you want to focus on breakouts and have a breakout strategy? Choosing the type of your strategy is important because each type of a strategy works in a specific market condition. For example, if you want to use a trend following strategy, it only works if the market is trending. It doesn't work in range market or choppy market. Or if you want to use a breakout strategy, they works better in trading ranges when the market is consolidating. So we have different market conditions like trending, ranging, choppy markets, volatile, and so on. And for each of the market conditions, different types of strategies are applied. And for applying each of these different strategies, you need different tools and analysis. So you must exactly define in your trading plan that under what market condition you're going to trade. In other words, what types of strategies you want to use. Trend following strategies are usually the safest option, offering the lowest risk because positions are taken in the direction of the current trend, and this is the reason that it's always recommended to beginners or traders who want to take lower risk. This is very important part of your trading plan because, as I said, trading under different market conditions need different types of analysis and tools. In the next step, you define exactly how your trade execution is. You must explain in details where, how, and why you enter a trade. Your trading setup must be defined here. For example, what kinds of indicators you use, what are their settings, or what kinds of patterns you use. In case if you use price action analysis, you must exactly define under what circumstances a trade entry is triggered. All the conditions must be mentioned in detail, and then you must exactly define where, how, and why you exit the trade. You must define how your stop loss is set, how your profit target is calculated. Are you going to use indicators for setting them or based on price action? Are you going to use fixed amounts for them? Are you going to use trailing stop loss? In what situations you will use trailing stop loss? Every detail regarding how you enter and exit a trade must be clearly defined here. And in the next step, you must define your capital management and risk management strategy. How much is your starting capital? How your position sizes are calculated? What is the maximum number of open positions at any time? How much should be your maximum risk on all your open positions? What are your daily, weekly, and monthly loss limits? How much is the maximum capital allowed in a single position? Are you going to hold your positions overnight or over the weekend, or you exit before? Will you hold your positions through major events like news releases, or you exit before? All of these types of questions that are related to your risk and capital must be exactly defined in your trading plan. Capital management and having a proper risk management strategy is one of the most important factors that play a crucial role in your success. I'm going to make a comprehensive guide on this subject soon, so make sure you won't miss it. And the next important element in your trading plan is having a plan for improvement, and trading journal plays an important role here. You must review your trades, you must monitor and track your mistakes, and regularly try to improve your mistakes. Just like a business plan, here also after making your trading plan, it's regularly monitored and actions should be taken so you can improve your mistakes and optimize your trading plan. And at the end, you must also define your objectives and goals in your trading plan. For example, are you going to withdraw your profit, or you want to compound returns for longer term growth? Are you going to have another job or a stream of income, or trading is going to be your only source of income? How is going to be your work-life balance? What hours you will trade? How much is your target percentage profit for the next month, quarter, or year? And questions like this that are related to your longer term goals and objectives. I highly recommend you to write your trading plan on a paper. I also recommend you to create a checklist based on your trading plan, so every time that you're taking a trading decision, you can be sure that you're doing everything based on what you have planned. You can create on Microsoft Excel, or a better option will be to print it and have it on your desk, so when you're executing your positions, you can check them all easily. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new video. See you guys in next video, and good luck with your trading.